Welcome everyone to Value Investing Live. I'm pleased to introduce our guest, Chip Rewey, the Chief Investment Officer at Rewey Asset Management. Chip has over 30 years of value investing experience with leading buy-side financial institutions. He has led many different strategies, ranging from small cap to large cap focuses, and concentrated 10 to 20 position strategies. As always, please feel free to post your questions in the live chat throughout the presentation, but keep in mind we're going to hold on to those until we get to the Q&A section at the end. I'll go ahead and hand things over to Chip now, and we'll jump into his presentation.
Thanks a lot, Graham, and thanks to Charlie and everyone at Guru Focus for the opportunity. It's an honor, and I look forward to it. And I do want to leave plenty of time for questions. I'll give a little bit about my background and my philosophy and process, illustrate that through two stock examples, and then go to Q&A. So, hopefully this can be educational for anybody and instructional perhaps. And please, just a disclaimer, this is not a solicitation of any sort or a recommendation of any sort of stocks. And one of my mantras is think for yourself. I truly believe that. So, just please use this from educational and informational standpoint. But again, I'm excited to present and tell you what I think of value investing. Little background on me, Graham gave some, and really what I think the takeaway from my career is I've worked for three value gurus: Laura Sloate, Jerry Cramer, and Marty Whitman. And I think all three of those have shaped my career and led me to where I am now. And I think my strategy is built on the strengths of all three of those. And dissecting it, Laura Sloate is a great value investor. She's really an inspiration. If you don't know much about her, Google her. She's been blind since 6 years old, but has really built up a firm and a fantastically successful value career. Really what she taught me is not only the blocking and tackling of this business, tearing apart financial statements and due diligence, but really two major takeaways. One, think about the business as if you were running it. Put yourself in the shoes of the CEO or managers and dissect the company on what's going on. Ask yourself what you do different, and that can be a good basis for asking questions to management. Why would you do this, or why wouldn't you do this? You can really understand the business. The second part is to have a vision for a company, not only what they're doing right now, but how that can evolve over 3 to 5 years. Where can profitability go? Where can revenues go? What's the balance sheet going to look like? Can they spin something off? What's the market share going to be? Today's income statement is a point in time, and it's relied way too heavily on in the investment community. We're interested in the balance sheet, and we're interested in looking forward 3 to 5 years. Jerry Cramer, I think, taught, building on that, taught the behavioral aspect of the business to me. We work on these stocks. We live and breathe our due diligence, our research. We talk to the companies. We think we know a lot about them, but at the end of the day, they're stocks and they don't have any emotion towards us. And the great investors don't have any emotion towards them. So when it comes time to sell, when it comes time to buy, be dispassionate, cut through the emotion, cut through the investor emotion, the neglect or the overabundance of love for companies, and get right down to what it's worth. And I think Jerry Cramer was kind of the best at that in the business. Marty Whitman, probably the most well-known of the group. Everybody knows his focus is balance sheet first, and I think for value investors, that's what matters. Marty focuses on the assets, and that's what the assets are worth, not what the balance sheet says they're worth, and that's a great takeaway. There do so all sorts of accounting vagaries and everything else. What are the assets worth, and what can they earn? And I think what I've taken away from Marty and built on from Marty is that second point. Really, what can the assets earn? Because if you just look at book value, you can get in trouble. One funny anecdote I have is if you just spend $1,000 on a brand new stagecoach, the day the railroad comes to town, that $1,000 isn't worth a lot, although it's marked at $1,000 on the balance sheet. So, it's really what you can earn on the asset, and really why I focus on return on invested capital. And just dragging that down, or distilling that down to what I think the competitive advantage is that I pursue here is moving those 3 points of view into one strategy, focusing, as I say, on long-term capital appreciation and downside protection. That is, downside protection protects you over your period of 3 to 5 years. Live to fight another day, and get through periods like COVID without being forced to sell, and have conviction to buy more when you have the chance. I strongly believe, and this is really a differentiation point of myself, that value is not the antonym of growth. I won't own the equity of a company that can't grow over time. And I think that's an important notion that value investors get hung up on sometime, or growth investors, when they think of value, they don't think growth. You're really buying undervaluation, and you're buying the ability to post high return on invested capital. That's what it is. We're not interested in buying cigar butts at cigarette butt prices. That's what Warren Buffett says. But really focusing on the ability to grow and earn over time. And I think if you focus on that aspect of what the assets can earn and what you can put up as far as ROIC, it helps you avoid value traps and avoid liquidating scenarios where the value might melt a lot quicker than you think. Where I focus now at Rewey Asset Management is small caps. And I'll get a little bit more into why. I think there are over 4,600 choices, versus if you look at large caps, there's, depending on what you're looking at, maybe 300 companies. So there's a lot more room to do effective due diligence, potentially to gain an edge through research and hard work, and to create a competitive advantage that an ETF can't arbitrage away. And if you own 15 to 25 names at the bottom, you don't own the market. Again, we're not interested in committing capital for market exposure. We're interested in return on invested capital, just like our companies are. Cutting to our philosophy, everybody's got 3 pillars. My pillars are downside protection. I talked about that, the ability to grow, in valuation. Downside protection starts with the balance sheet. It lets you live through rocky times, and there will always be rocky times in the stock market. Things don't go in a straight line, and there are always periods of over hype and over neglect. The ability to grow, I touched on, and of course, valuation. It's what you pay for, and as Jerry Cramer would say, you want return on capital, not return of capital. So there are a lot of great companies out there where the valuation doesn't make any sense in our book. So distilling that down and just hitting on that a little bit more, downside protection in the middle, I seek to identify companies with low debt, and again, with any contingent or off-balance sheet liabilities, any environmental liabilities, any litigation worries, anything that can drain cash out of a company that can impact your financial position, or force, in a worst case scenario, company that might have to raise financing, debt or equity, in a downturn. It's detrimental to your value as an equity investor. It's also detrimental to the strategy of a company to have the management team focused on raising capital or managing cash versus spending their time on how to grow the business and expand the business. So a weak balance sheet just sends a cascade of negative ramifications through a company. And that's kind of the first step. The ability to grow, I touched on. Again, we want to have high ROIC for at least our 3 to 5 year investment horizon. That's where, kind of Laura Sloate's vision comes into view. What can we do? What are you earning today? Where can these revenues go? Where can the margins go? Where can profitability go? Can the market grow? Can your market share grow? What are your competitors doing? There's lots of things there, but you've got to think forward and make sure your company is doing the right things, has the balance sheet to invest where needed, and is it competitive with their offerings today? And can those assets continue to earn a competitive cost of capital looking forward? Again, what they're earning today is no guarantee of what they can earn 2 or 3 years from now. And again, anything that just looks cheap or is in liquidation, or it could be a value trap. So I seek to avoid those. And then valuation, touch on that a little bit more. But again, a minimum discount to what I think is fair value. And my definition of fair value is where I think it should be trading today, not what it's worth in the future. In this market, I think there are opportunities where you can get much more than that, just given the volatility and some of the damage that's been done to smaller caps. Where I get ideas in the universe, I can get ideas from, and this is again why small cap and SMid cap is just a more fertile hunting ground than larger cap. First of all, there's more names. So if you've got an ETF in the large cap area, you can encompass more of those names, and there's a lot less potential for competitive advantage. But down cap, my primary benchmark is the Russell 2500 value. That's small mid. The Russell 2000 value is small. I kind of look at both of those. But if I look at companies with between 100 million and 10 billion in market cap, it's about 4,600 companies in the US. Not all those are covered by Wall Street analysts. A lot of those are unknown. And that's where, hard work and due diligence come into play and identify competitive advantage. And, you can see in the middle here, 2 main ways, not a secret, qualitative. And I basically say that's connecting the dots, looking at a 10K, a 10Q, press releases, conference calls. Get on the website of these companies, listen to their conference calls, look at their presentation. So lots of information there, and start asking yourself these questions on how would I manage the business? A lot of times you can get an idea from one company to another. I was visiting in a helicopter company one time, and they were trying to figure out how to make carbon graphite fit on the outside of helicopters, and they couldn't use fasteners. They had to have glue. The next question, of course, is who makes the glue, and is that company an investment? So really start thinking about the connections and connecting the dots for good original ideas. Quantitative screening, it's everything that you would think about. Screens aren't the be all, the end all. They're the start, their output is the start of my process. So again, everything that we would have talked about in philosophy, lower no debt, high and improving ROIC, revenue, earnings, book value compounding over 3 to 5 years. I like to look at things that are down on a 1 day, 1 month, 1 year, 3 year basis. The question is, why have they gone down? And are those temporary or permanent reasons? And if they're temporary, how temporary? And has the company got the balance sheet and the management team to fix them and recover? And those can make great value investments. But again, for wherever I get the idea, that's the beginning. And I would not recommend hopping from a screen to your portfolio. There's a large second step of what I call work in process. And not going to take you through this. It's pretty busy in great detail. But look at the capital structure. So Marty Whitman used to say, look at the capital stack, not just the equity, but the debt. What are the maturities? What's the structure? Is it variable? Is it fixed? What is their cash flow burn? When is the debt due? Is it due this year? Is it due in 5 years? Is it on a term facility that needs to be refinanced, or is it bonds that are outstanding? Those can come into play over a 3 to 5 year horizon. So you need to know where you stand in the capital stack. And as equity investors, we're always at the bottom. So you need to know who's above you and what the calls on repaying that are. A great place to start when you're looking at a new company is not only a 10K business description, but get the annual report and read the CEO letter for the past 1, 2, or 3 years. They're going to tell you what they want to do. And if they told you that in 15 and 16, they haven't done it, and 17, they haven't done it, and 18, they haven't done it, offers up a good question. Or if they are doing it, they're continuing to do it, offers up a good track record of being able to do it regardless of what the stock price has done. I do create a financial model for everything that I own. Not so much to beat the sell side. I'm not in competition with the sell side. I do like to understand sensitivities. How do margins hold up? Variable margins, as far as revenues, growing or contracting, and what are the fixed costs? Are fixed costs scalable, logarithmic, or stepwise? Just understanding those sort of things can help you get a better idea of a company. And if you do get a bad quarter or anything like that, having the model there to just run some sensitivities really can help you build conviction and potentially buy in the neglect and take advantage of share weakness, or conversely, be a signal that maybe you ought to move away. Accounting assumptions. One of the examples I'll talk about today, lease expense is really obscuring the balance sheet. You got to dig into how they account for things, and what the changes in the accounting regimes are for some of these companies, because they can make the balance sheet look different from year to year. I do have detailed calls with management when I can. Usually you start with the investor relations, but again, if you really take your time and understand these companies and have good calls with the investor relations, they'll usually let you go up the food chain and speak to higher people if they understand that you're putting the time into your work on the company. For every company I own too, I make an investment case, and I would recommend everybody does this. It doesn't have to be anything fancy, but put your assertions down, why you own it, what you think it's worth, and what would make you sell it. And that document should live through your holding period. And when there's times of hitting your price target or potentially going against you from purchase costs, bring that document back out. To what did you originally think and what's changed? That it's very important. And again, that removes a lot of the emotion. Oh my gosh, it's a great day. I feel wonderful that the stock's up, or I feel terrible that it's down. Remove that emotion, go back to your case, your model, your due diligence, and figure out if you should buy some stock or if you should sell it. This is how I move from a stock that I think is worth investable to how do I fit it into the portfolio. I think it's proprietary, and I'll walk you through this a little bit. I not only establish along the x-axis a price target and potential 3 to 5 year upside, but on the left side, I have a qualitative, and this is purely qualitative, risk weighting. And, I have an A company, which is potentially like a utility or a timber company, just real low risk, steady business, not too much volatility in the model. Conversely, a C could be a petrochemical company, an oil company, C for cyclical, anything where the business can change quickly. If you lay that over upside and downside, or if I lay that over, I should say, I think that helps dictate the position. For example, in the top right corner, if I can find an A company where I can get 50% upside, that should be a maximum position size for me, because it means I'm taking relatively little risk for a lot of return. Conversely, if I think I can get 20, 25% up, maybe just around 30, maybe I'll take a smaller position in that because I'm taking less risk. Or, and then converse that, if I have a cyclical company where things can swing on a dime, every year is different, every year there's many cycles within a year over a number of years, I never want that to be a top position of the portfolio, even if I get 50% upside, because things change quickly and there's not always times to react. But if you see 50% up in a commodity company, that can be a medium or a minimum size position for sure. And then just thinking that through, if it's a D company, why would I ever own a D company? The way I would think, bad management, bad balance sheet, bad market position, there's just no reason to get involved with those. Or if I can make less than 10% on a stock over 3 years, it's overvalued. And again, this is investing, you're buying for return of capital. So, I just really don't have interest in owning even great companies that are overvalued. So hopefully that gives a little thought about portfolio structure. This is also something unique that I try to do when I think about my holdings in a portfolio. I call it a correlation matrix. It's qualitative. It could be called risk buckets. It could be called anything you want. But basically what I'm trying to say is if I look at my portfolio versus if I look at, say, the Russell 2500 value, the 2500 value will have this much in financials and this much in industrials and this much in healthcare. It doesn't tell me anything about how the portfolio really is going to behave, because on the days China matters, my Hillenbrand, my GrafTech, my Ultra Clean will matter. What I don't have exposure to, REITs, utilities, transportation, energy, that's a big risk for outperforming or underperforming. There's some upside here, companies that I think could be vulnerable to activist actions. Some of it's positive. Where can I get good exposure to housing or 5G and artificial intelligence? So this just helps me quantify it. I do have weightings in here. I actually type the percent of what I own just to make sure, this is a subset. I've, of course, just cut it off for demonstration purposes. But it's something that, again, you should think just beyond, I have this much in financials or this much in industrials, because that hasn't helped me over my career. Industrials don't behave like other industrials on stress factors. And again, the most important part is when I buy something for myself or for the fund, that's just the beginning of my due diligence. The investment case, as I said, is a living document. You follow the company, you keep asking questions, and you keep learning, and, keep doing your own work. Sell discipline is easy. Price target has been reached. There's a better risk return scenario with something stochastically dominant. Maybe I'll sell a railroad if there's a better railroad and I don't want to own two. And the other part, if an investment case breaks, if I want to own something for A, B, and C, and B and C don't come true, there's no reason to be there. And there's a 4,600 stock universe. So get it out of the portfolio and get something else in. And again, remove the emotion from it. They're stocks, no matter how hard you've worked on them. There's plenty of others. Again, that's my disclaimer.